In order to be on the right side of change, we need to invest. We need to become investors or owners in tomorrow's AI-dominated economy. And if we are owners, we should consider taxes. Why? Because taxes will be our biggest expense. Fortunately, there is a good trick. So if you are an owner, an investor, you don't have to pay too much taxes compared to being a worker. Why is that? Because you only have to pay capital gains taxes, which are usually less than the usual taxes for workers. So if you make 100K as earned income, you get taxed at a higher rate, usually for most countries, I'm not a tax advisor, than if you make 100K from capital gains. However, if you have a large portfolio, you also don't want to pay these 25% taxes, and there are some alternatives you can do. Instead of selling positions where you realize the capital gains, and as you realize the capital gains in most countries, you need to pay the taxes. Instead of doing this, you can simply take a loan against your stock portfolio. For instance, there are some, like, I don't want to mention any names, but usually you can get a 6 to 7% loan. So you pay 6 to 7% annual interest. And you can take a loan against your stock position, for instance. This is called a margin loan. And in this video, we are going to address this one little question, which is interesting, but very risky. Yeah? So is it worth getting a margin loan? And the question answer is, it can be useful, convenient, and they are not risk-free and so on. So this is like all the usual disclaimers. It involves risk. You need to know what you're doing, but still, many people with large stock positions, inclusive myself, take margin loans, and margin loans are an interesting tool. And in this video, we are going to look at something really crazy. So if you are a very conservative investor, probably you want to turn this off now. Okay, so I did, and I wrote a Python script where I can check. I need to reconnect the engine, where I check how would taking, so if we would implement our strategy that I presented in the last two videos, which is simply take the top 5 companies by market cap and invest in them. So you can go back, check out the other two videos to see how it beats the S&P 500 in many instances. No investment advice. If you do this strategy, you could also add a layer of risk by taking margin loan against your position and putting the margin loan you get back into the position in order to leverage your gains. This is highly speculative, of course. I would say it's not as risky as, say, buying a house or so, if you don't take too much of a margin loan and if you know what you are doing. Because if you buy a house, usually you pay 10% or so in equity, and the rest you take a loan. So even small fluctuations in the price of the house can completely destroy your equity. Of course, these fluctuations, 10% fluctuations in the house price, are not do not happen overnight, but they can for sure happen over a period of a couple of years. Okay, so anyways, this one is looking now not at home prices or real estate prices and taking a loan against your real estate. It's taking a loan against a portfolio of some of the largest companies on the planet. So I would say, if you frame it like this, it's at least could be considered to do, right? And in the script, I can put in a start date and an end date, and it automatically performs a strategy of accumulating a position on margin. So if we invest 100, so if we can invest 10K or so initially, and we are just assuming that we initially invest 10K. I can give you the scenario. So say in the year 2014, we invest 10K for our normal portfolio. We invest 10K into the top 5 stocks by market cap. And if you want to know more about this strategy, then subscribe to the channel and check out our previous two videos. I will also give a link in the description below to the two videos: Backtesting a Winning Investment Strategy and Market Leader 5, the Passive Portfolio Strategy, if you are interested in this strategy. But now we are not talking about this strategy anymore, because this can be done with any strategy. You could even do this with an S&P 500 strategy, right? Putting everything into S&P 500, taking a margin, putting the margin again in the S&P 500, and paying the 7% interest fee annually. And of course, you need to expect that your position goes up faster than the 7%. Otherwise, it doesn't make sense even to pay the 7% interest if you don't expect that your position returns more in a given year. Okay, so now the strategy is in the first strategy. The simple scenario A is simply put it into the strategy. Scenario B is leveraging your margin capabilities. And for instance, in the year 2014, we start with an initial portfolio of 10K, and then we take a 50% margin loan against the position. So our loan to value is 50% at this point, right? So we have 5,000 in cash against our 10K stock position. And now this 5,000 in cash, we could either like spend it, and then we would simply have a loan but no assets, or we can put it back into the assets. We can buy assets against it. So now we have a portfolio asset-wise of 15K, but of course a loan amount of 5K plus interest, so 5,350, right? And our loan to value ratio is 0.36. So we have 36% of our assets are now actually liabilities, which means that we have some wiggle room, right? We still have 14% usually if we assume a 50% margin scenario. And now, like after the year 2014, we put this 14% that we can still take margin. We every single year we decide whether we want to buy new shares from potential margin that we can still get, because if our assets rise faster than our debt, then this means that we still have room, still have new margin every single year. So as our stocks rise, we can basically come back to the fifth. So the loan to value ratio reduces, and we can come back to the 50% loan to value ratio, so we can buy new shares every single year basically, right? Because and this only works as if the share prices rise, right? If the share prices fall, we basically need to sell shares, and this is what happened in the year 2022, where we needed to sell shares because our loan to value ratio rose to 55% of our position. And here you can see it visually. The blue line here is a simply buy and hold strategy. That's already interesting, right? In 10 short years, starting with 10K, we have reached a final portfolio of 63K. So the blue line is already interesting. We have 6x our portfolio using this strategy. But now we add another layer of risk and return by leverage, by taking loans against this position and putting the loans back into the assets. So we basically use liabilities in order to amplify our returns. And this only works if the returns are higher than the interest rate, which cannot be guaranteed, right? So it's risky. And you can see here from the year 2021 to the year 2022, our strategy basically showed a loss. So we basically lost some value. Our positions collectively went back. Our portfolio value went back. So here in the year 2021, we basically, so we can go back to this in the year 2021 here, we basically bought new shares, right? We bought new shares worth 26K, going from our loan to value ratio of 32% to 50%. So 18% of our portfolio we put back into our shares, into our investments, and increased our loan to value ratio. But now the portfolio basically fell, which means that our loan to value has increased to 55%. So we needed to sell new shares in order to adjust the loan to value back to 50%. So we sold a few shares. So this is like the flip side of using margin, right? Sometimes you are forced to sell to get your loan to value ratio back to the percentage you are allowed against your position. Usually it's like 33 to 50%. For like top stocks, usually it's 50%. Okay, so and here you see in the green line is basically, or is it green? No, it's orange line is basically our portfolio with buying on margin, and you see it's significantly higher than the blue line. Not only like twice as high, but more than twice as high, because we keep rebuying new shares. We keep using our newly gained loan to value. So we actually bought more than twice the amount of shares, and our portfolio value has significantly increased. But of course we have liabilities on the other hand, and the liabilities are given here in this dotted dashed line. Green, I think, I'm a bit colorblind. And you see the dashed line is even higher than the original portfolio value. So we have a lot of liabilities against our position. So it's usually not a problem if you have a lot of liabilities, if you have a much larger amount of assets on the other side, right? It's all relative. For instance, if you have $1,000 liabilities to buy a car, it might not be too much, right, for you, but it might be a negatively life-changing debt amount for somebody in Africa or so. Yeah, so it's all relative. And if you have a large asset base, then having a large liability base might still be okay if you can stomach the risk. And here in this red dash dotted line here, we see the net assets. So we simply have assets minus liabilities, and we can see that the net assets are still significantly higher using this margin strategy compared to our simple buy and hold strategy. So our buy and hold strategy again yielded 63K from just purchasing 10K worth of stocks once. We would have yielded quite a significant sum, right? Going from 10K to 63K, but with margin in this decade, we would have gone to net assets of 153K. And of course, we could then simply, so if we would, basically our portfolio value would be 280K, but our liabilities would be 127K. So we could basically sell 127K of stock to get back to zero out the margin, and then we would have net assets left of 153K. Okay, so this strategy worked for this period of 10 years. Let's maybe have another look at what happens if we use another period. So say if we go from 2004 to 2024. Is it 10 years? So let's see. Let's simply run this. The problem is that I here hard-coded the stocks we buy, which these are the top 5 stocks by market cap. If you look at the list of public companies in 2014, we have Apple, ExxonMobil, Microsoft, Google, and Berkshire. Now I would have to adjust the stocks. I would have to change the stocks here hard-coded. It's not like the prettiest Python script I have ever written, but okay. So let's simply try this strategy with those same 5 stocks. I think they already existed in 2004, and now our margin buy with margin position would be even outperformed our simple buy and hold strategy even more. So now we have here on the y-axis a portfolio value times 10 to the power of 6. So times, is it a million, right? And our final portfolio value for the simple buy and hold strategy would be $606,000, starting with our 10K initially. And if you add the margin to it, our net assets already would be 3.69 million, but our portfolio value would be 6.7 million already. So this would also have worked in the longer period of time of 20 years. And I have to say, I did not include, I checked only once per year whether the margin criteria was fulfilled or not. This depends on your broker, but sometimes they also check it on a daily basis. And if there is a small kind of flash crash or something, then you might be forced to sell your position to go back to the loan to value ratio for the flash crash, which would then mean the real performance could be worse or better. I mean, it really depends on the concrete terms of the margin. You of course would have to look this up. Okay, so no investment advice, but you can see how significant the difference can be buying with margin, buying assets with margin. It's like a proven strategy by many people. For instance, all real estate developers always buy their assets with margin, always buy with debt if buying assets with debt as the debts are expanding and there is some inflation, the value of the debt is usually reduced. And if your assets grow faster than your debt, I mean, this is somehow the critical thing, the critical element. If your assets grow faster than the debt, your loan to value ratio is never in danger. But of course, if you have some crashes, if you have some extreme events, and you could have those extreme events if you only choose a small portion, a few positions, right? Like Google or so, Microsoft, you can have these extreme events where, say, Google or Microsoft simply fails. Or even if you buy a broad index and you buy on margin, it could also happen that we have a crash like 2008 or so, where you are forced to sell your whole position in a very quick crash to cover the margin, which would basically mean that there is a risk for you to lose everything if you don't play it right. So margin is like a two-sided sword, and it cannot generally be recommended. In this video, I just simply wanted to do some numbers to show the potential of margin, and but you also need to be aware obviously of the risk of margin, and whether margin is a valid strategy for you or not is basically only based on your own investment preferences and risk tolerance. Okay, so I think this was a fun little exercise. Let's maybe have one more, just for fun, one more instance. So say we start with an initial investment of 10K, we have a margin ratio of 0.5, we have an annual interest rate of 7%, and now let's start with maybe in the year 2000. Let's have something short like 2019. So this is only a 5-year period or so to 2024. If you run it, you can see in the year 2019 we buy 15K, then we take loan against it, buy shares worth 2,150 to adjust the loan to value to 50%. Our net assets are now already 10,350, and then every single year we buy shares. Only in the year 2022 we basically sell shares to come back to the loan to value of 50%. And under these assumptions we can see initially, so here the blue line is the benchmark. We start with 10K, we end with 25K or so, and the dashed red line is our net assets. So this you can compare the net assets, and you see the net assets of our margin-based portfolio would be 44,000. Yeah, so this is almost twice as much as the normal portfolio. So it worked even in a short period of time. But of course, again, if you have a major crash or so, major corrections, usually you will see a compression of the gains. For instance, here in the year 2022, the net assets came dangerously close to the original position value of just buying and holding stuff. But then, of course, as the assets keep growing, the difference also keeps growing of those two curves. Good. Okay. So again, if you are interested in this kind of stuff, then check out the Finxter channel. The main purpose of the Finxter channel is to help you be on the right side of change. We address topics like these, unconventional topics like these. This is not generally recommended investment advice or anything. As I said multiple times, it's just like math, basically math and code, and we are just running this math and code to see different scenarios. Thanks for watching, and see you in the next video. Bye.